Let's derive the aggregate supply curve. We start with the relationship that's known as the Phillips curve, which is a relationship between unemployment and wage inflation or price inflation more generally. And it was noticed starting in the 1950s that there appeared to be a negative relationship between unemployment and inflation. That is, the higher unemployment was, when unemployment was very high, inflation was very low, and when unemployment was very low, inflation was very high. So there was this negative relationship between unemployment and inflation. We can write that as an equation looking like this. Inflation is equal to some negative term times the gap or difference between the actual unemployment rate and what's often called the natural unemployment rate. The natural unemployment rate is the rate at which we have ordinary, frictional, and structural unemployment. Frictional unemployment is unemployment that results from sort of the natural vagaries of human lives. People get tired of living in a city and want to move to another city, so they quit their job and they search for a new job. People get married. People move back to take care of an elderly relative. So all of those things mean that at any given point in time, in the U.S. labor force of 150 million people, 2 or 3% will not be working, will be unemployed, will be looking for a job because they've decided to change careers or change the place in which they live. There's also, of course, structural unemployment, which typically tends to last longer, and that's when, in the course of economic activity, we have displacement because somebody's come up with a new invention, and you have electronic word processing, so you don't need typewriters anymore. So all the people who worked in the typewriter factories making typewriters and all the typists who spent all day typing up reports on manual typewriters or electric typewriters, those people are now going to be displaced. They lose their jobs. It's no longer profitable for anyone to hire those kinds of people, and they need to search for new jobs. So that's structural unemployment. So at any given time, we'd have some frictional and some structural unemployment. We call that the natural rate of unemployment. There really isn't anything one can do about that natural rate of unemployment except have maybe better, more effective job training programs, make sure that people are aware of opportunities in other regions, maybe make moving for a new job be tax deductible, enabling people to do that without so much cost, etc. So our real focus in the equation then is on unemployment levels that are different from that natural rate. When the unemployment rate is much lower than the natural rate, we'll say that's a very tight labor market. So firms that have new innovations and are looking to expand don't have a pool of workers to draw from. They have to start bidding up wages if they want to attract workers to those to their expanding enterprises. So all of a sudden Thai food becomes the hit, and a whole bunch of Thai restaurants start opening up. But if unemployment's very low, then they're going to have to pay higher wages if they want to hire the waiters and dishwashers and managers for these Thai food restaurants. So the lower unemployment, the higher wages. On the other hand, of course, when unemployment is very high relative to the natural rate, then workers aren't in a good position to demand raises. Indeed, they might not even ask because they know that they're very replaceable because there's a whole pool of unemployed labor just itching to get a job. So inflation then, the Phillips curve tells us we might expect would respond negatively to the unemployment rate. We're going to add to the Phillips curve, we're going to call it an expectations augmented Phillips curve, because inflation also depends on expected inflation. If everybody thinks that the inflation rate next year will be 10% and everybody raises their menu prices and their catalog prices by 10%, and workers have negotiated a contract where wages go up by 10%, then in some sense inflation becomes self-fulfilling. Everybody has 10% built into their prices and wages, and they all go up by 10%. So inflation would be 10% regardless of what the situation is in the labor market. So we have an expectations augmented Phillips curve. The last thing we'll do is add a price shock. So occasionally, in particular, we get oil price shocks where oil prices increase a lot, and that will feed into inflation if oil. It's hard to think of any other commodities that are so important in the production costs of so many different kinds of economic activities. But we'll often think of that as an oil price shock being an oil price shock. Now this Phillips curve we can transform a little bit because there's a regular relationship in many economies called Okun's law that suggests that unemployment and GDP gap are quite closely related, and for every increase in unemployment of 1 percentage point, there's a half a percentage point, a 2 percentage point increase in GDP. So the relationship between the GDP gap and unemployment gap looks like this. It's called Okun's law, and we can then substitute the GDP gap into the unemployment gap. Now this GDP gap is the difference between actual GDP and potential GDP. Potential GDP is an important concept. It's the GDP that would result if we were at the natural rate of unemployment. So that is, if there was just frictional and structural unemployment, ordinary structural unemployment, so all workers are being employed, what would be the value of GDP that's produced? So we're going to call that potential GDP. So now we have a aggregate supply curve where we've substituted, and we're just using this gamma to represent that omega times times the 0.5. So we have inflation depends on expected inflation, depends on the GDP gap, and depends on the price shocks. So that describes a positive relationship now. The higher is GDP, the higher will inflation be. The higher GDP, so if GDP is higher, unemployment is lower, and so inflation is higher. And we think of this as very simply, the higher is GDP, the more workers are employed, the less unemployment there is, and so there's greater wage inflation that then feeds into price inflation. So a pretty simple story. Price shocks will shift this aggregate supply curve, so oil price shock shifts the aggregate supply curve upwards. Expected inflation will shift the aggregate supply curve. Higher expected inflation shifts the aggregate supply curve upwards. So now we're ready to see the aggregate supply curve in terms of potential GDP. Let's suppose we were at a point here on the aggregate supply curve. Well, GDP is higher than potential GDP. So GDP is here, and it's greater than potential GDP. So that tells us that inflation this period will be higher because we have a positive GDP gap than it was last year. So that means that next year the aggregate supply curve will shift upwards, because we're typically going to have the aggregate supply curve be backwards looking. So instead of expected inflation, we'll have inflation last year plus the GDP gap, y minus yp, plus the price shock. So every year that inflation, the GDP is above the potential level of GDP, the aggregate supply curve will shift up, and we'll get higher and higher inflation as long as GDP is above the output gap, above the potential level of GDP.